All right, let's talk about a word you've probably heard 1,000 times, usually when things are going wrong in the economy: derivatives. They sound incredibly complicated, almost mysterious, right? But what are they really? Well, today we're going to peel back those layers and look at them for what they are: one of the most powerful and, yeah, most misunderstood forces shaping our world. This is about the architecture of abstract control.
So let's just start with one big question. What if you could take something as intangible as risk, as abstract as the future, and turn it into a product? Something you could literally buy and sell, just like a barrel of oil or a share of stock. Well, that is the fundamental, world-changing question that derivatives answer.
To even get our heads around how that's possible, we have to start with the absolute basics. So, first things first, what exactly is a derivative?
Okay, so every single derivative, no matter how complex, has to be connected to something in the real world. This is what we call the underlying asset. It could be anything: a share of Apple stock, a bushel of wheat, a government bond. Think of it as the anchor to reality, the one thing that keeps this whole system from just floating off into pure theory. And this is the derivative itself. Notice the key word here: contract. It's not the asset, it's a contract about the asset. Its value is, well, it's derived from the price changes of that underlying anchor. It exists in this really strange space, somewhere between presence and potential. It's not what is, but what could be.
This table, I think, really nails the difference. Owning a stock is pretty straightforward, right? It's about possession. You have it, its value is right there. But owning a derivative, that's all about prediction. It's a bet on which way that stock price will move. You're no longer tied to the present reality of ownership. You're suddenly liberated into this wild world of abstraction. So you have to wonder, why did we even create these things? Well, the official story, the promise behind them, was actually pretty noble. It was all about taming the chaos of the future. The central idea is something called risk transfer. It's brilliant, really. It allows someone who has a risk they don't want, let's say a farmer who's worried about crop prices dropping, to sell that risk to someone else, like a speculator who is totally willing to take on that risk for the chance to make a profit. Risk itself becomes something you can package and sell.
And this defensive move, that's what we call hedging. It's basically a way to bake prudence right into the financial system. So instead of just hoping for the best, you can turn a terrifying unknown, that future uncertainty, into a manageable number, a known cost you can actually plan around.
This classic example just shows it perfectly. Our farmer is worried, so she uses what's basically a time machine of finance, a futures contract, to lock in a price for her corn today, even though she won't harvest it for months. Just like that, her future uncertainty becomes a present-day certainty. And that risk of falling prices? It's now been transferred to a speculator who's betting on the exact opposite outcome.
But, and this is a huge but, hedging is only half the story, because the very same mechanism that lets you transfer risk also happens to be an incredible engine for amplifying financial power.
And that engine's name is leverage. Think of it as a financial multiplier. It's what allows a tiny amount of actual money to control a position that's just vastly, vastly larger. And of course, that means it amplifies both your potential gains and your potential losses.
So let's see what that actually looks like. To get into a big derivatives trade, you don't put up the full amount. No way. You just post a tiny fraction of it as collateral, and that's called the margin. So let's say you put down $5,000. That's your skin in the game. But here's the magic trick. That $5,000, it might let you control a position with a notional value of $500,000, or even more. It's absolutely staggering, right? This is where you really see how modern finance operates, where the amount of control you have can just dwarf the actual amount of money you've put on the table. So once you have that kind of incredible power floating around, it was basically inevitable that derivatives would evolve way beyond that simple farmer's hedge. They started to create their own reality, purely abstract markets. And a market just completely exploded. It wasn't about managing the price of corn anymore. It became a place where traders could invent new instruments to literally put a price tag on the most abstract human concepts you can imagine: the fear a company might go bankrupt, the trust in a country's economy, even the probability of a natural disaster. The credit default swap, or CDS, is the poster child for this whole phenomenon. It started out as simple insurance against a company defaulting on its loans, but it turned into a massive speculative casino. See, you didn't even have to own the company's debt to buy the insurance. You could just place a bet that a company would fail, effectively turning catastrophe into a tradable product.
It's like being able to buy fire insurance on your neighbor's house and then kind of hoping it burns down.
You might be wondering, how is any of this even possible? How do you price something so intangible? Well, that's where the math whizzes came in. Super complex models, like the famous Black-Scholes formula, basically created a new language for this world. They gave traders a way to calculate what looked like a rational scientific price for all these future possibilities.
And this led to maybe the most mind-bending concept of all. Traders could now isolate and trade volatility itself. The actual ups and downs of the market, the chaos, was no longer just a risk you had to avoid. In these new markets, volatility became a raw material, a substance that you could shape and sculpt and profit from.
Okay, so when you put all of these pieces together, the abstraction from reality, the insane leverage, this pricing of uncertainty itself, you finally arrive at the grand thesis. You see derivatives as a true architecture of control.
And this quote, man, it just says it all, doesn't it? The calculus of capitalism. Calculus is the mathematics of change, of motion. This new system isn't about the static value of stuff you own anymore. It's about controlling the rates of change. It's a massive shift from a world of possession to a world of pure prediction.
And this control, it operates on all these different levels. It gives us a new language for chaos by turning uncertainty into an equation. Through leverage, it takes tiny decisions and amplifies them into huge global waves. With tools like futures, it lets us literally slice up, price, and sell the future. It lives in that weird space between what is and what could be. And finally, it wires the entire global financial system together into one single, hyper-connected nervous system.
And that's really the bottom line, isn't it? What started as a simple, practical tool for farmers to manage risk has morphed into something so much more bigger. A system that aims to control not just money, not just credit, but the realm of possibility itself.
Which, of course, leaves us with one last, massive, unavoidable question. If this architecture of abstract control now has its hands on the future, who exactly is controlling the architects?